In this week's update, the extraordinary bifurcation of the US market, why lithium has fallen off a cliff, and protecting the downside while leaving the available upside open. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe the video. Brief market perspectives to start with. I've been getting questions of late, more than usual, about the markets in general globally, the Australian market, the US market, and whether there is too much danger out there to be investing. Should I sell everything and just wait for a better time? And these sort of thoughts come up from time to time, and rarely are markets a general buy where you can say, you really should be really levering into the market at the moment. Times like early 2009 after the GFC, a couple of months after the COVID crash. These are times when the market has been completely oversold, and you can go in and buy wide portions of the market and expect to do reasonably well. But those situations occur very, very rarely. Most of the time, the best avenue for making reliable and attractive returns are by astute stock picking, being able to isolate the companies that are going to do best more than the majority of the market. And there's many stocks out there in the top 100, top 200 in Australia that have done almost nothing for 5 years or 10 years, and many that have in fact gone down over that time and have lost investors' money. It's more a smaller portion of the market that has done really well. And right at the moment, I think that's probably even more the case. And so I think where we stand right now, it's being an astute stock picker or having someone do that for you is not only required, it's become almost essential, because there is a lot of significant danger out there. And I think there's a fairly good chance that wide sections of the stock market can do quite poorly in the next couple of years. So I can't stress enough the importance of being tapped into a source of the sort of stocks that are going to do well, that are going to provide outsized gains, and are not going to give you too much to be concerned about, because their businesses are just on such a solid footing, and their growth paths are so strong and so assured that they're going to pretty much do well no matter what happens. So let's have a quick look, just in overview, of the what and the how. Last week I said there was a better way to manage risk, or how to better manage risk, and that was companies that can function well in a tougher environment because they've got pricing power, they've got economic moats, they've got fantastic management teams, all these sorts of things, but they all add up to the one thing, that no matter what central banks do with interest rates, no matter what happens in the trade war between America and China, no matter what happens anywhere around the world, that these companies are going to continue to do very well. And as long as you don't overpay for them initially, either from a fundamental valuation point of view or just from the point of view that the share price has gone up very, very significantly in a short space of time, and it's overhyped and overvalued. So as long as you don't do that, then these companies are highly likely to produce outsized returns over the next 2 to 5 years. The more that you can pre-think the journey before you buy, the better off you'll be. And it will give you less stress and a better overall result. Now, what do I mean by pre-thinking the journey? Look, there's a couple of aspects to that. One is that you've got to understand very clearly what your purpose is with this investment. Is it seeking capital gain and a bit of a dividend? Is it a dividend play? Is it for the next 12 months? Is it for the next 5 to 10 years? So be very clear about the purpose. The second thing is have an exit plan, at least in mind. Now, of course, we don't know the prices that we will exit, but we can have a methodology for exiting. And I've got 3 very clear, unequivocal triggers that I use for exiting my core long-term positions. And those boxes either get ticked or they don't. So I have very little indecision. I have very little stress about how I manage my long-term core portfolios because I've pre-thought the journey before I did it. So the more you can do that, or the more that you can align yourself with someone that can help you do that, then the better off you will be. What it all gets down to is, and again, I get lots of questions about, what's happening with this market or that market, and what do you think about this factor? They're all unknowables generally. They're things that we can't control. But there's a lot of things we can control. We can control the stocks we buy. We can control what price we pay. We can control the weighting that we expose ourselves to. We can control how we take profit or how we exit if it doesn't work out. In my experience, there are many, many things that we can control. And if you do that and just use the power of probability, we can't get every single investment right. Not possible. But if we control what we can control and we do it well, we do it rationally, then we can do better than just about anybody else out there. That's the key message. American stocks, the S&P just keeps rattling on, up another 1.55% across the week, but the NASDAQ absolutely shot the lights out, up 3.5% last week. But tellingly, and this is really the key point that I want to get to, and I foreshadowed it last week, and that is the equal weight S&P index was actually down 0.5%. And the Russell 2000 IWM is also struggling. It's not going anywhere. So this is a market that's being led by a relatively small number of mega cap stocks, particularly in the technology area. And, that's not what you really want to see for a market to be sustainable to the upside. So that's the big story of the US market at the moment. It's this incredible bifurcation. In other words, we've got a few performers, but we've got an awful lot of non-performers or even underperformers. So that's just something to be aware of. Now, again, what is it that we can control? Well, as I said before, we can control what we buy, what price we pay, what weighting we assign to it, etc., etc. There are many things that we can control. And just because the US market is getting very, very narrow in leadership does not mean that you should not participate, because there are some absolutely stunning small to mid-cap US stocks that are very, very strong growth companies. The outlook is really, really good, and they're cheap. They're trading on PE multiples around 10 or 15 times, and yet they're providing earnings growth of 40, 50% and higher year on year. So you don't want to take yourself out of the market because you're worried about the big picture. There are some gems, and there are always some gems in the market. So just go and find those. The US dollar index was higher at 105.5. The 10-year yield fell a little bit further, which is, of course, is helping the big technology stocks. Not that they need a lot of help at the moment. They're just massively in favor. And the VIX was up very slightly from 12.2 to 12.7, which is really neither here nor there. So let's take a look at some charts. And we'll start with the S&P. This is a weekly chart. You can see very strong week, sort of not that far off what we saw in towards the end of April. And we've had, if you look at the number of green candles versus the number of red candles since the bottom at the end of October, you can just see how overwhelmingly dominant this move to the upside is. There's no question that the S&P 500 and also the NASDAQ is incredibly strong at the index level. But it's what's going on underneath that. Unless your portfolio is very, very heavily skewed towards stocks like Nvidia and Microsoft and Apple and AMD and all those sort of stocks, then you're dealing with the rest of the market. And this is RSP, again on a weekly chart. And this is the bit that just starting to bother me. Just not that it stops me from investing in the market. It doesn't. But it just causes me to be a few notches more conservative than I normally would be. And it's not only the fact that RSP is underperforming relative to the S&P, so the S&P going up very strongly, RSP not. So that's a relative comparison. But look at it in absolute terms, which is what this chart is showing you. It's not going anywhere. So that's just something to be aware of. And if we look at IWM, which is the Russell 2000, then it had another down week. And since the little breakout we got here in late February, the market's done, the Russell 2000 has done effectively nothing. So it's just something to be aware of. Let's have a look now at the rest of the market. We've looked at the Nasdaq. Let's look at semiconductors. Naturally, with NVIDIA doing what it's doing, the semiconductor index is just off the map. Now this is justified. The increase in semiconductor stocks is justified because they're growing. NVIDIA is growing at an extraordinary rate, which I covered last week or the week before, just looking at the earnings growth versus their multiple. It's really not that expensive. Now, that flies in the face of what a lot of people are assuming, that it must be expensive because the share price has, trebled or something in the last year. Therefore, it must be expensive. But their earnings are just rocketing up so far. But the question is, has this gone too far? It's a valuation question, and it's always a difficult one to answer because, what is a fair valuation for stocks producing the earnings growth like NVIDIA? Is it 20 times? Is it 50 times earning? And it's very much tied into prevailing sentiment, and sentiment can change. So the valuation question is always difficult to answer, and that's why I always default back to we can control what we can control. We can't control how sentiment will change. The market today is prepared to pay 50 times earnings. Tomorrow it's 25 times earnings. We can't control that. But what we can control is the weighting, our profit-taking strategy. There's many things that we can do to still make good gains in this sort of market, but not be exposed to the potential risks that are there as well. All right, let's dig down into that's the spread between the semiconductors and the S&P. It's just off the planet at the moment, as you would expect, but that really doesn't tell us anything we don't know. Let's look at the relevant comparison chart. XLK has just absolutely taken off the last couple of weeks. XLC, which is communication services, that's another one of the 3 or 4 main aggressive sectors of the US market. We've got consumer discretionary and healthcare and consumer staples all sort of sitting in the middle. And then towards the bottom, energy has fallen out of bed. Finance is backtracking after doing reasonably well earlier in the year. And we've got materials down here as well. As the US dollar has gone up, that's impacted commodity prices, and it's certainly impacted commodity stocks. So that is a market that is heading into very, very distinctly different directions. And what you own has never been more important. Let's take a peek at the Australian market while we're here. Information technology has really just been going sideways over the last month in Australia. Finance has improved significantly, but I'll have more to say on that in a minute. Healthcare, similar to information technology, it's really just up and down, improved a little bit in the last week or so, but generally where it was a month ago. Small caps struggling again in the Australian market. And then we've got energy, and then right at the bottom of the pile in the last month, we've got materials, and they really have had a hard time of it. And it's not just the iron ore price that's doing this. For whatever reasons, there seems to be a significantly negative sentiment has taken hold in the Australian mining sector. All right, I'll just check on the currencies. So US dollar had a good couple of days to finish, and that left our dollar a little bit weaker, but probably holding up a little better than you would expect at about 65.5. So just confirming all that, 65.5 for our dollar. Our index lost 1% across the week. Banks were strong, but as I covered last week, they really do look poor value in the sense of being able to provide a good long-term return, particularly Commonwealth Bank. Now, I'm not saying that the price of Commonwealth Bank can't continue to rise a bit, and I'm not saying that it's necessarily going to fall over. But if you want a good long-term return, then to my mind, you don't want to be paying 22 times earnings for a stock that has slowing earnings per share growth when their normal historical range is somewhere between 12 and 16, 17. You're just not going to get a good long-term return if you're buying in at that point in time. So I find it hard to see how the banking sector can continue on its current run. And of course, it was another pretty poor week for materials. But fortunately, there are some gems. There are a few small cap quality businesses that are doing well in terms of price, also doing well in their business. So they're the ones that I focus on almost exclusively. Precious metals, gold was up $39 to $23.32, so a bit of a recovery. Silver has broken important support, but it did rally back a bit at the end of the week and finished at $29.55. So I'm in a point of indecision when it comes to silver. And it would seem that the shock of China not buying, China Central Bank not buying gold in the month of May, the first time in 18 months, has not worn off yet. The precious metals market is not looking all that fantastic at the moment. There's nothing happening globally with, if you look at GDX or GDXJ, and in Australia, most precious metal stocks are struggling. But there are a couple of real stars, and again, that's what I focus on. I'm not really interested in the rest. Just show me the ones that are doing well, and we've got a couple in the Insiders Club portfolios. So let's go and have a look at the precious metals market. All right, there's silver. On a weekly chart, you can see the important support that got broken at around $30. I'll just flip over to a daily chart. So it was down, and Thursday night it looked pretty ordinary, but we did get a bit of a turnaround on Friday. It's very important for silver that it gets back above $30 and does it fairly quickly. So that's the silver market. I mean, the long term for gold and for silver is really, really good. But the fundamentals and logic don't always play out in the price. The two things can go in different directions, and at the moment that is certainly partly the case. There is the gold price on a weekly chart in US dollars. So you can see a bit of a positive week, but it's certainly in a bit of a high-level consolidation at the moment. You'd want to hang on to the this level here around just under 2,300, and ideally you want to see a break back above 2,400. So that this 2,300 to 2,400 area is pretty important for the short to medium term outlook for gold. That's gold in Aussie dollars. I would imagine that we will perhaps get a little bit of an improvement in sentiment on Monday. So that is the precious metals market. Turning to other commodities, copper was up slightly. Nickel was down to $7.85. And again, we've got a situation here where the fundamental logic is screaming at us that copper should be going higher. And some of the major investment houses are making some extremely bullish calls on copper. But the reality is that the price really isn't playing ball at the moment. We've got copper supply is quite tight, and the growth in supply is completely inadequate to meet future demand. So a couple of things are going to happen here. One, at some point, the price is going to have to move, but like uranium, that just sat there for something like 2 or 3 years, where the logic was so compelling it was ridiculous, but the price didn't move. And then eventually it did, and it went from $30 to $100. I suspect that a similar thing is going to happen with copper, but the question is when. We don't know, and so that's one of those things we can't control. So if you want to make copper investments, then have a clear plan and make sure that you're only dealing with the best assets that you can find, and make sure that your plan sets out your weighting and your entry technique and your profit-taking technique, all of those sort of things. Pre-think it as much as you can. But copper is a bit of a head-scratcher. It should be doing better than it is. But reality is the stocks are being shunned. And it was a very poor week for copper stocks. In fact, a very poor week for just about all critical minerals stocks. Crude oil was up a little bit, about $3, up to $78.45. Now, just a quick look at lithium. Sentiment has turned dreadful again. There's definitely a cooling of support for the pace of decarbonisation. I read very widely, and there's nothing definitive that I can sort of point to other than just this general sense that consumers around the world just seem to be less keen to pay the price for rapid decarbonisation. So moving to net zero targets quickly, because I think there's an understanding that that is going to impede economies, it's going to impede people's personal lifestyles to an unacceptable degree via higher energy prices, etc., etc. So I think there is a cooling of support, and whether that is being reflected in the lithium price, I don't know for sure, but I'm just sort of putting it out there. That's logical, and it's certainly something that I'm seeing. There is also a bit of a shift being reported. I can't say that this is backed by factual stats, but there is a bit of a shift back towards hybrids because of, again, cost, consumers feeling the pinch. And there's also been an increased supply in a couple of key areas. So you put those two things together, a bit of an easing of the demand pressure plus increased supply keeps the lithium price subdued, and that causes the lithium stock prices to be fairly poor. And we saw last week across the board, whether it was the lithium majors like Pilbara Mines, Min Resources, IGO, or whether it was the raft of development stocks, the hundreds and hundreds of development stocks, they all had a shocker of a week. So is this an opportunity, which is, again, another question I'm getting asked? Is this an opportunity to buy into the sector? My very definite answer is no, not yet, because there's no telling how far down prices might go before they eventually turn around. So be guided by the charts here. Good, smart investing is about not taking chances, not guessing or hoping that you'll be right or that we're near the bottom. It's just about working the probabilities. And with the market falling as it is, it's just not a smart time to be trying to catch the falling knife, because that's what we've got in the lithium sector. The charts have got to be our strong guide, and I'm very, very comfortable paying 10 or 20% above the lows to have a higher degree of confidence that we've seen the lows, rather than try to guess it. This spot copper chart up very slightly at the end of the week, but nickel continued on the downside, and how those two markets have changed just in the space of a few weeks is quite significant. You go back a few weeks, and the copper price was roaring up, and everything looked fantastic, but it's come off the boil just as quickly. All right, wrapping it up. What do you need to do well? And again, this is just variation on a theme. It's the whole purpose of why I do these Sunday videos, to provide that perspective that just hopefully helps investors keep their head clear. And the first thing you need is a clear plan. And if you don't have one, then I'd suggest that you're in a significant amount of trouble, because the market will get you if you don't have a very clear plan about what you're doing, what stocks you're buying, how you buy them, how you exit, all those sort of things. What is your time frame? What is your purpose? Now, having a clear plan is something, and I've been working with traders and investors for 20 years. So I know how people think and I know what they do. And the vast majority, for whatever reason, still resist sitting down and penciling a clear plan. It's very simple. There's nothing complex or time-consuming in doing it. It's very simple. And if you don't know how to do it, or it's just you just don't know where to start because you don't know what some of the answers are, then you can get assistance with that. So get a clear plan. There are stocks that will keep increasing in value, both in terms of the value of the business, but also in the share price, no matter what. No matter what central banks do, no matter what interest rates are, and they'll do it with a high degree of probability. And we are laser focused in the Insiders Club, and to a degree in Portfolio Analyst, at identifying those sort of stocks and working with them to capture that value. So there's no question in my mind. History shows it, and the outlooks for these sort of stocks is still very strong. The next thing you need, because even if you've got a clear plan and the right sort of stocks, all of us carry around a certain amount of psychological baggage due to past events that have occurred, either in the market or outside the market. And of course, we've got the media sitting on our left shoulder, chattering away all the time, giving us all these sort of negative, confusing thoughts. So you need a supportive environment where you don't get thrown off track. It's just such an important part of the mix. Now, if you're a successful investor and you do it all on your own, fantastic, good luck to you. But you're in the absolute minority, because most people aren't in a position to do that. So that supportive environment is incredibly important. And if you're not getting the sort of results that you're happy with, then you need to reflect on whether it's the environment and your decision-making that is the main part of the problem. Well, last week in Portfolio Analyst was what to do about gold, because obviously with China Central Bank doing what they did with the slide in the precious metals prices, it created a lot of uncertainty. We also looked at my preferred plays in the gold market as well. The other area that we looked at is hydrogen. My personal view is it's too early for retail investors to be looking in that area. There's too much risk. And history would show that there is the time frames to bring these projects to commercialization is best left to governments and organizations with extremely deep pockets. But anyway, there was more on that in Portfolio Analyst last week. So if you're interested, there is a $1 2-week trial, and you can soak up a lot of value in Portfolio Analyst during those 2 weeks. That's it from me for this week. There's the email address and more information on our website. And I'll be back with you next Sunday. Cheers.